Okay, so you want to own a $1 billion startup. A pitch deck, a founding team, a few years of grinding, and suddenly you're the next headline, the next unicorn, the next name investors name drop at dinner. It sounds like the cleanest path to generational wealth that modern capitalism has ever produced. No factory, no inventory, no physical product weighing you down. Just an idea, some code, and a valuation that climbs faster than almost anything else in business. Here's the twist: almost nobody explains before they start fundraising. Being a billion-dollar company on paper and actually owning a meaningful liquid slice of that value are two completely different things, and a shocking number of founders discover, years into building something genuinely valuable, that they own less of it than they think, and control even less than that. By the end of this, you'll know what it actually costs to chase this outcome, how the ownership math really works round by round, what the hidden costs are that quietly shrink a founder's slice long before any exit, and what a realistic outcome looks like once the unicorn fantasy meets the actual cap table. Let's start with what this actually costs to attempt, because unlike almost every other business we've covered, the entry cost here isn't really measured in dollars spent, it's measured in equity given away. A founder typically starts owning close to the entire company, splitting ownership with any co-founders, and setting aside an option pool for future employees that commonly runs somewhere around 10 to 15% of the fully diluted shares at the seed stage. Then the actual fundraising begins, and each round sells a meaningful chunk of the company to new investors, with a typical round giving up somewhere around 15 to 25% of the company at that point in time. A slice that comes directly out of every existing shareholder's percentage, founders included. Recent data on global startup funding shows the market moving at a genuinely staggering pace, with total investment reaching close to $300 billion in a single quarter this year, the highest quarterly figure on record, and a wave of new companies crossing the billion-dollar valuation threshold as a result. But that fundraising environment cuts both ways for a founder, because more capital flowing into the ecosystem doesn't mean founders keep more of their companies. It often means the opposite, since larger rounds at higher valuations still dilute existing shareholders by the same proportional mechanics, regardless of how many zeros are attached to the deal. So how does the ownership math actually flow round by round? Because this is where the fantasy and the spreadsheet stop agreeing. Say you start a company owning 50% after splitting with a co-founder and setting aside a pool for employees. A seed round selling 20% of the company to new investors doesn't just cost you 20 points, it dilutes your 50% proportionally, leaving you with something closer to 40%. A Series A doing the same thing, on top of that, pushes you down further, and by the time a company has raised through a Series B or C on its way to a billion-dollar valuation, founders who started with the majority of the company routinely find themselves holding somewhere between 15 and 30% by the time of a meaningful exit, even though the company they're holding a smaller slice of is now worth exponentially more than it was at founding. This is genuinely the entire game, and it's worth sitting with the logic for a second, because owning 20% of a billion-dollar company is worth dramatically more than owning 80% of a $2 million company, and the whole point of raising money is trading percentage for the capital and growth needed to make the smaller slice worth vastly more in absolute terms. The problem is that this math only actually works out if the company keeps raising at progressively higher valuations and eventually reaches a real liquid exit, and the overwhelming majority of companies chasing this outcome never get there at all. Now for the stuff nobody warns you about before the first term sheet gets signed. First, the option pool mechanics quietly determine who actually pays for future hiring, and if a new pool expansion gets added into the pre-money valuation of a round, which is extremely common, founders bear essentially the entire cost of that dilution, while incoming investors pay a lower effective price per share for the same ownership stake, a structural detail that can cost a founder several additional percentage points they never fully priced in at the negotiating table. Second, liquidation preferences reshape what actually happens at an exit in ways that can genuinely shock a first-time founder, since institutional investors typically negotiate the right to get their invested capital back first, before common shareholders, including founders, see a dollar, which means a company can sell for a headline-grabbing number and still leave founders and early employees with far less than the valuation would suggest, particularly if later rounds were raised at aggressive terms during a hot fundraising environment. Third, cap table complexity has become a genuine structural problem in the current environment, with a small number of companies raising outsized mega rounds that concentrate ownership and control among a handful of late-stage investors. And industry reporting this year has specifically flagged a growing pattern of well-funded unicorns sitting stuck, unable to raise their next round or find an exit, precisely because their cap tables have become so complicated that new investors won't touch them without a full restructuring. Fourth, the extended timeline to any real exit means founders and employees can spend the better part of a decade holding equity that's valuable on paper and completely illiquid in practice, since IPO timelines have stretched considerably and strategic acquisitions of the largest private companies have slowed, leaving a growing population of paper billionaires unable to actually access any of that wealth without a company-sanctioned secondary sale. Fifth, down rounds and recapitalizations. When a company has to raise at a lower valuation than its previous round because growth didn't meet expectations, can wipe out founder ownership entirely in the worst cases, with genuinely inverted cap tables where investors collectively hold more of the company than the founding team, a structure one investor recently described as making a company essentially uninvestable, without a completely new lead investor willing to rebuild the entire ownership structure from scratch. So who's actually winning at this? The data here is genuinely brutal and worth sitting with, honestly. Recent analysis tracking a cohort of over 1,000 seed-stage companies found that only about 1% of them ever actually reach unicorn status, while a full 2/3 settle into what the industry bluntly calls zombie companies, neither growing meaningfully nor dying outright, just surviving indefinitely without ever generating the kind of outcome that makes anyone rich. Venture capital as an industry is explicitly built around this reality, with firms openly accepting failure rates north of 90% across their portfolios, because the mathematics of the power law means a tiny handful of genuinely massive winners, the 2 to 4 companies out of every 100 that generate outsized returns, cover every single loss across the rest of the fund many times over. The number of new unicorns created annually swings dramatically with the broader funding environment too, climbing past 120 in the peak year of 2021 before collapsing to under 30 in the more cautious years that followed, which tells you plainly that even reaching this milestone has as much to do with market timing and investor sentiment as it does with the underlying business itself. Founders who do make it through to a real, liquid exit overwhelmingly share a specific pattern. They raised disciplined amounts of dilution at each stage rather than giving away more than necessary just because investors were offering it. They modeled cumulative dilution across future rounds before signing anything, and they treated every point of ownership surrendered as something that needed to buy back more than its cost in growth, talent, or speed. How do founders actually lose the most value on this path, even when the company itself looks successful from the outside? Almost nobody loses because the product failed or the market disappeared. They lose because they gave away too much ownership too early, at overly generous terms, simply because capital was available, and the fundraising environment made it feel easy, and by the time later institutional rounds arrive and reset the cap table around more sophisticated, better negotiated terms, the earliest holders, founders and angel investors alike, find their stakes diluted down to a sliver of what they started with, sometimes down to barely 1 or 2% of a company they helped build from nothing, even as that company's headline valuation keeps climbing. Okay, so what does a realistic outcome actually look like? Take a founder who started with roughly 50% ownership after a co-founder split and an employee pool, raised disciplined rounds giving up around 20% of the company each time, across a seed, a Series A, and a Series B, and reached $1 billion valuation, with the company having raised a total of around $80 million along the way. After that sequence of dilution, That founder realistically owns somewhere in the 20 to 25% range, worth $200 to $250 million on paper at that valuation, a genuinely extraordinary outcome, though almost entirely illiquid until an actual exit event occurs. Now the harder, more common version. A founder who raised more aggressively, gave up closer to 30% per round, chasing the highest valuation available, rather than the best terms, took on a liquidation preference structure that favored later investors heavily, and reached the same billion-dollar headline valuation, might realistically own closer to 8 to 12% by the time of an exit. And once liquidation preferences are paid out to investors first, the actual proceeds landing in that founder's pocket can be a fraction of what the simple ownership percentage would suggest. Sometimes tens of millions rather than hundreds of millions. On paper, the exact same billion-dollar outcome. In practice, a dramatically different personal result. So yeah, you can build a billion-dollar startup, and if you do, it can genuinely be one of the most extraordinary financial outcomes available in modern business, a level of wealth creation almost no other path offers at this speed. But the odds of getting there at all sit somewhere around 1 in 100 from the earliest stage. And even among the rare companies that do cross that threshold, how much of it a founder actually ends up owning depends far less on the size of the headline valuation and far more on the discipline of every single funding decision made years before anyone was using the word unicorn to describe the company at all. The founders who come out of this with real, life-changing wealth aren't the ones who raised the most money the fastest. They're the ones who understood, from the very first term sheet, that every percentage point given away had to buy back more value than it cost. Because by the time the valuation gets impressive enough for headlines, it's already far too late to renegotiate the terms that decided how much of it would actually belong to them.